If I had to start watching this market today from scratch, knowing what I know about the Mag 7 earnings wave, the Fed meeting, Nvidia's breakout, oil pressure, and the way consumers are starting to act, I would not treat this like just another week. Most people see a quiet trading day and think nothing is happening. But quiet markets can be the most dangerous ones because that is when the big players are not sleeping. They are waiting. They are waiting for the number, the sentence, the earnings call, the guidance line, the one little comment that gives them permission to move. Today is Tuesday, April 28th, New York time, and comment below what day and date you are watching from. And if you value this kind of market breakdown, support the channel by subscribing and commenting John AG Best below. That tells me you want more clear, direct, no-nonsense coverage like this. So in this video, we are going to walk through exactly what I would be watching right now. The broad market setup, the Mag 7 reports, the Fed, Nvidia, semiconductors, oil, Domino's, defense stocks, biotech, AI software, rare earths, consumer names, and the small caps, where the risk is just as big as the reward. So let's get into it. You had red on the screen. You had green on the screen. You had stocks moving in completely different directions. But underneath that noise, the broad market was still firm. The S&P traded in a tight range and still pushed into record territory, which is not bearish behavior. That is the market saying, I am not ready to break down yet, but I need a reason to go higher. This is why the Mag 7 matters so much. Microsoft, Amazon, Apple, Meta, Alphabet, Nvidia, and Tesla are not just popular names anymore. They are the market's engine room. When they report, they do not only move their own charts, they move sentiment, they move earnings expectations, they move index flows, they move the whole conversation. Based on the latest public market calendar, this week has the kind of setup that can change the tone fast. A large group of S&P companies is reporting, the Fed is meeting, and several mega-cap technology names are scheduled to give investors fresh guidance at almost the same time. That is not a normal week, that is a stress test. Apple adds another wrinkle because investors are not only watching earnings, they are watching leadership, China demand, tariff exposure, and whether the next phase of the company can still feel as steady as the last one. When a stock that large faces transition, even calm language can move expectations. That is why the call matters more than traders may admit this week too. Now here's where it gets interesting. The market does not just want to know whether big tech beat earnings. That is the old question. The new question is, what are they spending on AI? And is that spending turning into money? That is the entire Nvidia story right there. Nvidia has been strong because investors believe the AI infrastructure build-out is still early. They believe the demand for chips, racks, networking, cooling, power, memory, and data centers is not a one-quarter fad. Recently published market updates showed Nvidia pushing into record territory again, as investors looked ahead to earnings from its biggest customers. That matters because Nvidia's customers are also the companies deciding how much capital gets thrown into the next wave of AI. Because Nvidia's rally is not just about Nvidia. It is about whether the spending machine behind Nvidia keeps running. But let me give you the other side too, because this is where a lot of people get lazy. AI spending is bullish until the market decides it is too much. If big tech spends hundreds of billions and shows expanding profit, investors clap. If big tech spends hundreds of billions and margins start getting squeezed, investors panic. Same spending, different reaction. That is why CapEx commentary may be more important than the headline earnings number. Everyone wants to know if AI is still the greatest growth story in the market, or if it is becoming the most expensive arms race in corporate history. And that takes us to the Fed. The Fed meeting is not only about whether rates move. Sometimes the decision itself is the least important part. What matters is the tone. If inflation is still sticky, if oil is still pressuring energy prices, if the consumer is getting weaker, the Fed has to choose its words carefully. Too soft, and inflation expectations can heat up. Too tough, and growth stocks can wobble. According to the official calendar, the Fed meeting is scheduled across Tuesday and Wednesday, which means investors are dealing with earnings and central bank risk at the same time. That combination creates a market where people do not want to be too early, but they also do not want to miss the move. Now let's talk about oil, because oil is the problem sitting in the corner. The Iran situation and the Strait of Hormuz concern are not just geopolitical stories, they are inflation stories. If oil rises, transportation costs rise. If transportation costs rise, food and goods cost more. If food and goods cost more, consumers get squeezed. And if consumers get squeezed, companies like Domino's and McDonald's become signals, not just restaurants. Domino's was punished hard after the latest results. Recent reports showed a sharp stock drop after earnings missed expectations, and same-store sales came in softer than investors wanted. The deeper issue was not that people suddenly hate pizza. The deeper issue was that the consumer is becoming more selective. That is the part you have to watch. If sales dollars rise only because prices are higher, but volume is weak, that is not the same as healthy demand. That is inflation hiding inside the revenue line. It looks okay for a second, but the customer is telling you something. They are saying, I will buy, but only if the deal is good enough. I will order, but not as often. I will trade down. I will skip delivery. I will wait for a promotion. McDonald's is a much stronger, more proven machine. It has scale, global reach, brand power, and a dividend history that income investors love. But even McDonald's is not immune if lower-income consumers start cutting back. Higher gas, higher rent, higher food, higher debt payments, it all comes from the same wallet. So do not ignore the restaurant names. They can tell you what the consumer's feeling before the official data catches up. If you're successful, share your success story in the comments so others can stay motivated. Now, defense stocks are giving a completely different message. You would think defense stocks should fly when geopolitical risk rises, but markets are not that simple. If expectations are high, if contract terms get questioned, if buybacks slow, or if earnings are merely okay instead of excellent, the stocks can fall even while the long-term demand picture is still strong. The defense budget story is still there. The drone story is still there. The robotics story is still there. The unmanned systems story is still there. But investors may be rotating from older defense names into faster-moving next-generation platforms. That is why names like ONDS, Red Cat, and AVAV get attention. But you have to separate theme from quality. A drone theme can be powerful. A weak balance sheet can still destroy the trade. A government contract can be exciting. Dilution can still eat the shareholder. So if you are looking at these names, do not just ask, is defense spending going higher? Ask, can this company survive long enough, execute well enough, and capture enough of that spending without constantly raising money? That question matters more. Now let's move to the speculative names, because this is where people either make big money or learn expensive lessons. Huma has the kind of biotech story that attracts attention because the product idea is not tiny. Bioengineered blood vessels, trauma repair, dialysis access, these are serious medical markets. There are upcoming trial and filing catalysts. There is already some regulatory validation, but tiny biotech is binary by nature. Good data can change everything. Bad data can change everything faster. Eli Lilly is a very different kind of healthcare setup. Everyone knows the obesity drug story, but the latest acquisition activity shows the company is still building beyond that headline. Blood cancer, oncology, immunology, neuroscience, those categories matter because a giant drug company cannot live forever on one theme. The stock is expensive, but sometimes expensive stays expensive when the pipeline keeps widening. CLSQ is a tiny security chip idea tied to post-quantum protection. The concept is fascinating because future computing power may force companies to rethink encryption, but it is still early, still small, and still speculative. Fast growth from a tiny base sounds amazing, but tiny bases can also make risk look smaller than it really is. SoundHound is a different kind of speculation. The live person deal gives it a bigger enterprise base and a better story around voice AI, customer support, and conversational tools. The company has also pointed toward a much larger revenue base in the next couple of years once the deal is integrated. That sounds great. But here is the catch. An acquisition is not proof. Integration is proof. Margin improvement is proof. Customer retention is proof. Revenue quality is proof. AI software stocks are not going to be rewarded forever just for saying AI. IBM already knows that feeling. It beat expectations, raised the dividend, and still had investors asking what the growth engine really is. That is because AI creates a strange problem for mature tech companies. It can help them automate, it can help them sell new tools, but it can also pressure consulting work, services revenue, and older software models. So the question with IBM is simple. Is AI a tailwind, or is it quietly eating part of the old business? Adobe has an even sharper version of that problem. Adobe is still a high-quality company, but AI-native creative tools are attacking the edges of its moat. A recent downgrade pointed to tougher competition, weaker conviction, and limited near-term catalysts, even after the company announced a massive buyback plan. That tells you something important. Buybacks can support a stock, but they cannot replace growth confidence. If customers believe cheaper AI tools are good enough, Adobe has to prove why its platform still deserves premium pricing. And that is the AI disruption story people do not always want to hear. AI creates winners? Yes, but it also attacks old winners. Rare earths are another major theme, and USR is one of the cleaner examples of why the market cares. The company announced a major deal to acquire Serra Verde, a Brazilian rare earth business with a producing asset. Recent reports put the transaction around the high $2 billion range and highlighted the importance of heavy rare earths used in defense, electronics, and energy transition supply chains. Because rare earths are not just mining, They are magnets, they are processing, they are defense, they are electric motors, they are drones, they are supply chain independence. The market likes stories that move from someday to closer to now, and a producing asset can do that. But do not fall asleep here either. Mining deals still need execution. Integration matters, funding matters, processing matters, politics matters. A strategic story can attract buyers, but execution keeps them. Poet is the warning label on the other side of small cap excitement. Photonics can be a real opportunity, but if a disclosure issue leads to a contract termination, the market does not just punish the event, it punishes trust. And when trust breaks, charts can develop ceilings because trapped buyers sell into every bounce. RZLV is another high volatility setup. Retail AI platform, beaten down stock, analyst optimism, heavy short interest, possible path to profitability. That combination can move violently on good news. But short interest is not automatically bullish. Sometimes shorts are wrong, sometimes they are early, and sometimes they are right because the business still has something to prove. ACE is more boring, and that is not an insult. Doors, locks, access systems, smart security, global buildings, dividends, steady industrial demand. It is not a meme, but it can still matter. The catch is liquidity and listing structure for U.S. investors, plus earnings risk when expectations are already high. WLDN is more practical. Energy consulting, utilities, cities, efficiency, infrastructure planning, and data center power needs are all becoming more important. As AI data centers demand more electricity, companies that help plan, save, and manage energy can become more relevant. But even good businesses can face profit pressure if tax benefits fade or margins tighten. And then there is ALET. This is the kind of stock where I would be careful before trying to catch the falling knife. Cloud-based human capital tools sound fine. AI-powered services sound fine. But weak results, competition, debt concerns, dilution risk, a listing warning, and possible reverse split pressure are not little details. When a stock gets into that zone, the story has to become dramatically better just to repair confidence. This market is not simple right now. The index can make records while individual stocks break down. Nvidia can surge while Adobe struggles with AI disruption. Rare earths can rally while consumer names warn about household pressure. Defense spending can look strong while defense stocks correct. Small caps can double and still be dangerous. That is why this week matters. The market is waiting to find out whether earnings support the move, whether AI spending still looks productive, whether the Fed stays friendly, whether oil stays contained, and whether the consumer is bending or breaking. If the answers come in strong, this market can keep climbing. If the answers come in messy, the same tight range that looked calm can turn into a fast repricing. So I would not chase blindly, and I would not hide blindly either. I would watch the companies with real cash flow, real demand, real balance sheets, and real catalysts. I would be selective with speculation. And I would remember that in weeks like this, the headline is rarely the whole story. The goal is not to predict every tick. The goal is to see where expectations are fragile, where evidence is improving, and where hype is outrunning reality right now. And just remember, this is for education and market perspective only. It is not financial advice, and I am not telling you what to buy or sell. Use this as research, check the facts yourself, know your risk, and never let one exciting story replace a real plan.